Hello everybody, Keith Collins with the Keith Collins team. We're certified mortgage planners at a local direct mortgage lender called Alpine Mortgage Planning, and this is the weekly mortgage update. So three things. I'm going to go really quick because there's a lot of information. So three things I want to talk about today. First, Freddie Mac. A lot of lenders in our local area aren't Freddie Mac approved. So a lot of times when a lender qualifies a borrower, they're only thinking Fannie Mae guidelines. There's a couple instances where Freddie Mac will actually approve a borrower for more or something different than Fannie Mae will. So whenever you're working with a lender, always ask, did you also check Freddie Mac guidelines? And two instances would be this. The first one is debt-to-income ratio. Freddie Mac has a 50% debt-to-income ratio. Fannie Mae has a 45%. So by design, someone will qualify for more on a Freddie Mac loan than they will on a Fannie Mae loan. So always ask, did you look at Freddie Mac? And a lot of our lenders will say no because we're not approved. The second is when we use a non-occupying co-borrower. For example, a parent co-signing for a son or daughter, a family member co-signing for another family member. Somebody is co-signing for another person to qualify because the occupying individual cannot qualify for what they want on their own, so they need someone else to help them buy that property. Fannie Mae does not allow you to blend debt-to-income ratios, essentially eliminating any benefit of a co-signer to help someone get qualified, whereas Freddie Mac does. Freddie Mac will blend the debt-to-income ratios. They put all the income into one pot, all the debts into one pot, and blend the ratio to help somebody qualify. So if we have a parent that makes a ton of income and maybe a son or daughter that makes a little income, the parent can help the son or daughter qualify on a Freddie Mac loan. Again, Fannie Mae doesn't do that. Second thing, FHA. So on FHA, I was really surprised when talking with a real estate agent yesterday that they were unaware of the non-occupant cosigner program for FHA. FHA also allows for a parent, family member, aunt, uncle, brother, sister to cosign for another individual. And also do it under the regular FHA 3.5% down, 30-year fixed at 3.25% right now with no points or origination fees. So again, if we're working with borrowers and they're not qualifying for maybe what they want, or what they need, let's always ask about cosigners. You can do it with FHA, you can do it with Freddie Mac, you just can't do it with Fannie Mae. Final update is HomePath and condos. So condos are a really difficult bird to get financed in our local marketplace right now because of the issues with the homeowners association. Either the occupancy rate is not right, there's litigation issues, or the big thing, which is tough to follow, but no more than 15% of the homeowners can be more than 30 days past due on the monthly HOA dues. And that's a big deal because when people foreclose or do a short sale, they stop making the HOA payments. On a Fannie Mae HomePath condo, we don't have to do a homeowners association certification. So therefore, if those issues are present, it doesn't negatively impact our ability to finance that property as long as it's a HomePath loan on a HomePath condo. So if there is some condos out there that are HomePath eligible, we might be able to get financing in those communities under a conventional program. So that's all I have for you today. I'm going to be out next week, so there will be no mortgage update. I'm going to be gone all week at an industry conference in Palm Desert. So the following week will probably be a really good update. But thanks for tuning in. Keith Collins, Alpine Mortgage Planning, 916-253-7820, 916-253-7820. Hope everybody has an awesome week. Take care.